Thank you, everyone, for being here. Welcome to our Search Funder session on landing the whale. We started these Search Funder sessions about a month or so ago, and the first people that we reached out to were Lisa and Heather. They've been longtime Search Funder members and supporters of the Search Fund community. They actually joined Search Funder before we had much of anything. So I'm sure they will remember what it was like when basically we were a blog. We didn't have the investor match feature or the deal match feature. It was really hard to connect. I don't think we had messaging at the time or any other the other features that you see today. So they have been real troopers with us at Search Funder, and I always hear wonderful comments from our searchers about the quality of the work that they do. And I'm very excited that we're going to be presenting this presentation to you today. So the agenda is essentially, I'm giving the floor to Lisa and Heather. They're going to introduce themselves in more detail and then go through a series of case studies. From there, I'll probably have a few questions, and then we're going to open it up for your questions because this is your time. We will end the formal session at noon, but both Heather and Lisa have agreed to stay on for a few additional questions if we happen to go over time, which I expect we will given the number of folks here. I want to let you know that this event is being live streamed on Search Funder, and we will have a playback available afterwards on Search Funder as well. So thank you, everyone, for being here. Thank you, Lisa. Thank you, Heather. I can't wait to learn a lot from you today.
Great. Well, thank you so much. And thanks for the invitation and the ability to help to continue to support the community. And yeah, Heather and I remember we were early adopters of your platform and what you've been trying to do for the community, and just been great to be alongside you as you've continued to progress and just grow your strength as a platform for the community. So much thanks to you as well.
I guess we'll do our quick introductions. I'll do mine first, Lisa, and then yours. I've been at this a long time, over 25 years, primarily focused on SBA, but in the last 4 years also focused on conventional financing. Here at Live Oak Bank, we're divided into industry verticals, and our vertical is focused strictly on M&A financing across all industries. But if you bring us a deal for which the bank also has a vertical, you get our expertise plus that vertical's expertise. I'm based in Orange County, California. Our programs are all nationwide, and our headquarters is in Wilmington, North Carolina. So with that, I'll give it to Lisa.
Yeah, great. So Heather and I have been partners in M&A finance for the better part of 10 years. She and I have been at 3 different banks together, and we're I think quite the team, the dynamic duo. I live in Washington, Seattle, Washington, and again we've focused, we've separated ourselves and differentiated ourselves in what we started out doing in the SBA space by focusing 100% on M&A buyer financing. And then we realized we were onto something when largely getting our entree into Search Fund through the self-funded model. And then realizing when we brought our ideas to Live Oak that we could also expand that and cover the entire breadth of the Search Fund community by doing self-funded SBA, also traditionally funded conventional, and then independent sponsor, given how they kind of fit into the mix. And we're also doing some private equity deals as well. Okay, great. I guess I should go ahead and get started. So today we are going to talk about doing larger transactions. So I'm going to cover a slide on how to do an SBA transaction with a combo junior debt piece, and that would be a live oak junior debt. And then we're going to talk a little bit about that, and then Heather's going to talk about how we are doing our traditionally funded transactions and show you a conventional non-recourse transaction. So Karen, why don't you move to the slide that is titled e-commerce women's clothing? Great. And then I'd like to just start by talking about some of the distinctions you're going to notice and kind of come up against when you're doing a larger transaction that still kind of largely fits into SBA kind of mindset, lower middle market, but you need some gap financing. It's a little too big, or maybe a lot too big, to fit into just that $5 million cap on SBA. Some of the things we're going to see is that on the bigger deals, it's a higher multiple, bigger EBITDAs, sort of better EBITDAs. So generally that means a lot more equity needs to be brought to the table, because with a typical SBA transaction, it might be 10% down, 10% seller note, and 80% financing. That might be a real typical kind of down the fairway structure. When we get into the larger EBITDAs, because we max out at the $5 million of SBA 7A debt, we're going to need to see larger amounts of equity in. We're generally kind of as high as 20 to 25% enterprise value of equity being brought to the table, with a combination of seller note generally, and then our junior debt in second position. I'm going to actually walk through a slide, but just want to share some of these thoughts with you of things that you're going to see. And I think one of the biggest distinctions is that when you come into a larger transaction, you're going to have a lot of different kinds of competition. You're not just going to be in competition with other SBA type buyers, but you're going to be in competition with strategics, and you're going to be in competition with family offices and private equity firms, especially when you start getting into EBITDAs of $2 million and above. So generally, you might think that you're going to lose out every time, because that seller is going to go off of price every time. And that's not the case. There are a lot of attributes that you can still bring to the table that put you in good stead to compete against a strategic. At the end of the day, if that seller is simply looking for price, you're probably going to lose in more cases than not. But you have a lot of appeal that you bring to the sell side, and that is protecting their legacy, protecting their employees, protecting things that this seller has worked on for the better part of 20 or 40 years of their life to build this company. And that's where we see our searcher CEOs really can compete against the strategics and the private equities that may be offering a heck of a lot more multiple, but you're bringing something very tangible in the seller's eyes to the table. So just want to give you some hope out there that you don't necessarily have to compete just fully on price, but the multiples are going to be higher. So let's move to the case study. So interestingly enough, this is an e-commerce company. And I know a lot of the times, the thought is, well, no one's going to finance an e-commerce company, because talk about asset light, talk about, all the value built into that goodwill number. But for certain kinds of companies that check all the boxes, we can certainly do an e-commerce. And this one has a lot of key strengths to it. It's a high growing company. So that can kind of be good and bad, because a lot of the value, a lot of the debt service coverage is based really on that last full TTM. So if you look at the use of funds, kind of break down the transaction to put something into context here for you. The price was 8.5 mil. We provided all in on a transaction of 9 million. We provided the 5 million of the 7A. Our junior debt, conventional second position, $1.7 million. And then the seller carried back $1 million worth of seller note. And then we had equity of about $1.3 million. So basically about 14% injection, 11% seller note, and we're doing about 75% of the transaction. Hold on, I'm just getting a call in. Let me mute that. Great. So on TTM, this is 6 times multiple. on a 3-year average, it was close to 7 times multiple. So you can see that it's a nicely growing company. And one of the things, well, several things we liked. One, it was, a nice growth story, which is compelling for us. It's absolutely compelling for the for the investors and the board of directors for sure. But it had excellent brand reputation. It wasn't an Amazon reseller. This is a proprietary brand, proprietary website, all built out, repeat customers, and outside of sort of the big Lululemons and outside of the big Athletas, it has an amazing brand name in what is really a fragmented market segment outside of some of the biggies. So there's an ability to continue to grow and expand some of their product line. And I am allowed to mention the name of the brand. It's Sanita Athletics. So for those of you on the phone, and it's right now, it's really focused more on women's sportswear. It's amazing. They compete against Lulu by having amazing quality product with a price point that the average person can afford in comparison to sort of the Lulu. The board of directors had experience in e-commerce. The investors had an e-commerce expertise, and our buyers, while maybe they were a little bit on the personal financial statement light side of things, their experience and their resume was quite impressive. They had design experience, inventory management, and vendor relationship experience. So those were all the things that were key in our minds. And then also there was some structuring on the seller note where debt service coverage, need to maintain that at a 1.5 minimum debt service coverage, or the seller note can be clawed back and peeled back just to make sure that transition goes well and that these growth trends are really sustainable. So our term on our junior debt, I should also mention, is a 7-year AM, 7-year term, which is still a nice amount of amortization behind that 10-year SBA term. So with that, I think I'll either open that up to questions, or Heather, did you want to continue on into your conventional and then we can open it up for broader questions? I'm good either way.
I think we're going to continue and then do Q&A all at the end.
Great.
Unless you have something you want to throw at us now.
Let's continue on, and feel free, guests, to put questions in the chat if you'd like. I'm very enthusiastic about this company, and I can't wait to look it up. So the only question I had was, how do you spell the name so we can put the link to it in the chat?
It's Sanita, S like Sam, E-N-I-T-A, Sanita Athletics. I'm wearing their leggings as we speak. I don't think you could see it because I have a stand-up desk, but I'm wearing their leggings.
So we'll go ahead and put that info in there. Help give them a boost.
Right.
Yeah, and I guess the way it'll work is just so you guys don't forget. If you guys start typing questions into the chat now, as they come up, at the end we'll go through them and sort of like have Heather and Lisa answer them. So you feel free to start typing the questions in the chat now, and then we'll go back and go through them at the end.
Okay, great. Let's go. There we go. Next slide.
Yep. Construction software company.
No, one more after that. We're going to skip this one. This was another SBA companion. So I'm going to cover this one, the Internet Awards platform. This is a conventional deal, and while you're looking at it there, the first question we get a lot from searchers is, what are the differences between SBA and conventional? Why would I choose one versus the other? And the primary answer is, if you're self-funded, you're almost always going to choose SBA. And if you're traditionally funded, you're almost always going to choose conventional. And I say almost, it is always. I've never seen anybody cross over for a number of reasons. A few other reasons why you would go conventional. Maybe you're self-funded and you might still think about conventional if It's important that you have seller rollover equity. SBA doesn't allow that, and that's often something that we use in conventional deals. There are no earnouts with SBA, something again that might be helpful in a deal. And if you had to have it, you would have to go conventional. If the seller was going to stay on past 12 months, which is the case in this deal, they're going to stay on the management team. That's something that SBA does also not allow. So, there are a number of reasons why you might go with a conventional program, but the main driver is if you're traditionally funded, this is the program that you're likely going to use. The other thing about the conventional program is that we don't require a personal guarantee as long as the EBITDA is at least 1.75 million or above. So none of the investors have to guarantee. And if you have anybody that owns more than 20% for an SBA deal, all those over 20% owners do have to provide a personal guarantee. So that's another reason. And the final reason you might choose conventional is if you have a financing need greater than about 7.5 million. Those programs that Lisa was just showing you where the SBA plus a Live Oak Bank companion loan, they max out at 7.5 million total debt. So 5 million SBA and 2.5 million companion. So if you need more than that, and here's an example of a deal where they wanted to fund about 10 million, that's definitely something that you're going to need the conventional program for. So the highlights of the conventional program guidelines are, as I mentioned, minimum EBITDA of 1.75 if you want to have no personal guarantee. We will consider a smaller deal, less than 1.75, but someone, probably the CEO is going to have to give a personal guarantee. It's very difficult to find conventional no PG financing for small companies. It's just considered a little bit higher risk because they're smaller. The maximum senior debt that we'll allow is between 40 and 50% of the enterprise value, excluding junior debt. Maximum 2.75 turns of EBITDA, and a fixed charge coverage of at least 1.5 or better. And the final qualifying criteria is, a highly qualified CEO and a board of directors where at least someone on the board has some industry experience. That's, a lot of times we're asked, if I, the CEO, don't have industry experience, is that going to be a problem? No, both in the SBA programs that we offer as well as the conventional. But we are going to look to see who the board of directors is comprised of and if there is some experience there, and there usually is. That's usually how we make up for that. With a conventional program, there's always covenants. And something I wanted to point out is with SBA, there are not. So a lot of people don't realize that there's no covenants with an SBA loan, but there are none. With a conventional loan like this, there are fixed charge coverage ratio covenant, leverage covenant, and usually some type of liquidity covenant. We do try to set the covenants around your growth plans. So although you look at the underwriting that we're showing you here, and it's all historical, it's all historical and TTM, but where the growth plan is important to the lender is really around how are we going to set the covenants? How aggressive is this growth plan? Is there going to have to be a lot of capital investment in the growth plan to where it might affect the way we set the covenants? So that's important for us to understand going in, mainly for those reasons. But again, the qualifying for the conventional loan is going to be based on the historical trailing 12 primarily, and primarily what we see in the Q of E. We always provide, so you'll see there in the first column, the term Live Oak Bank LOB term loan. We provided 10 million or 30%. So this was a pretty low leverage deal. Again, we could go 40 to 50%, and most search funds do choose to go a little bit higher. But in this case, the multiple was an 8x, a little higher than that actually. And, the higher the multiple, the more equity you're going to need. And ultimately the lower the leverage that the cash flow can support. And the second column is the Live Oak Bank line of credit, LOC line of credit. So I did want to kind of point out that we always provide some sort of working capital component to all of our acquisition deals. Usually it takes the form of a line of credit. And it's based on what the particular needs of that business are. This is a pretty small one, especially compared to the size of the business, but that's just because that's the way their cash flow worked, didn't need much. But there sometimes is a need for quite a bit larger one that might even be tied to receivables. I wanted to point out inventory is a lot harder to include in a borrowing base on a line of credit than just receivables. So if you're looking at a deal where their existing line of credit includes an inventory, in their borrowing base, that's something we want to vet out early, how much inventory we'd be willing to lend on. In this case, rollover equity. So seller is staying on in a key role. Again, something you can't do with an SBA loan, but is often done with conventional. And then quite a bit of equity here in this deal, a little over 40%. Really stable historical cash flow in this one. So this one, I think, is just a good example of kind of pretty easy to underwrite deal for us. Now, as Lisa pointed out, it doesn't have tangible collateral, it doesn't have assets. And we get asked that question a lot. Is that a problem? No, in fact, we're a cash flow lender. So it's really important when you're deciding, who you want to be your lender, that's the type of lender that you need for leveraged transactions. You need a cash flow lender, not an asset-based lender. So we don't really focus on assets at all in our underwriting. In fact, we actually prefer asset-light companies for one simple reason. The assets in a heavy equipment company, it's very difficult to determine the proper maintenance CapEx figure. And I always tell searchers that are looking at companies like that I've never closed on a deal with a lot of equipment on the balance sheet where the CEO didn't come back to me later at some point and say, the equipment wasn't in as good of condition as the seller represented. And we had to spend more on it than we thought. So it is frankly easier to underwrite an asset-light company where we don't have that consideration or that concern. But there it is, a small line of credit in this case. Some things to think about for larger deals. Same thing Lisa said, it is the larger the EBITDA, the more competition you're going to likely find. Although we have seen a few larger deals landed that were proprietary and did not have that competition, so that is still something that is a very viable path for you. I would also add that the proprietary search method seems to be stronger than ever right now because of the economic conditions, and a lot of sellers and founders who just simply are ready, more ready than they were before to go ahead and turn the company over to someone else. So I am seeing a slight uptick in proprietary deals and really good quality proprietary deals. So if you're pushing down that path, I want to encourage you because it is seeming to be doing quite well. Other thing to consider in a large deal, we do not require quality of earnings for SBA loans. The only time we require them is where it is maybe a carve out or something like that. We do sometimes advise getting them, we just don't require them. With a conventional loan, it is required. It's really what the underwriting is based on. And you see here the TTM Q of E as of 5/31 in this particular deal. So the reason I point that out is it matters, who your vendor is. You want to talk to the bank about who you're planning on using and make sure it's someone that the bank is comfortable with. But also it affects the timing of your underwriting and your closing ultimately. So we don't really underwrite. We pre-flight, we issue a proposal letter before the Q of E, but we don't actually do our underwriting and our final commitment letter until we have that Q of E in. So it does, your kickoff of your Q of E and when that first draft comes in that the bank can start to look at really affects, how soon you can move into closing. Especially.
I will add on to that, Heather, though, as far as the Q of E with SBA, both of our or all of our junior debt ones, because they're larger transactions, and a lot of the time there is a heavy emphasis on TTM. Q of Es are also kind of du rigueur or du jour for some of the larger SBA transactions. And in both of our SBA junior debt slides here, Q of Es were absolutely required and were already going to be obtained by the searcher going into it. But yeah, generally on most SBA, probably not. Just wanted to make that distinction.
Yeah. Yeah, and there, I would say probably 20% of all of our SBA borrowers do go ahead and do a QV voluntarily, just on their own, just a good practice. But I just wanted to make the distinction that once you're looking at a conventional program, it's really the basis of the underwriting, where as opposed to a typical SBA loan, the basis of the underwriting is really tax returns and being able to verify those tax returns with IRS, whereas that's not the way we approach a conventional deal at all. And again, I already pointed out this, but I have it in my notes here that, we do find the asset light deals kind of easier to underwrite. So the highlights of this particular deal was, it had high barriers to entry, a really good brand, basically, management continuity, which, because of the rollover equity, very stable cash flow. This was low leverage that was requested. Earnings were very stable. There were also COVID tailwinds, and so that's always nice to find these days. And a board with industry experience and no customer concentrations, high recurring revenues, kind of checked all the boxes as a nice big deal to underwrite. And of course, the bigger the deal, the more you want to check all the boxes. It's easier to forgive a few things where the risk is lower because the deal is a little bit smaller. But the bigger you go, the more, you do want to find a company that and ask for a financing package that kind of fits the guidelines really, really well. Before we open to Q&A, I did want to also answer a question that we get asked a lot lately, which is, what's the environment right now for lending, given COVID and everything else that's going on. And I did want to share the good news, which is that we're still lending. We're having a very big year, actually. Our searchers are, I think they were always looking for the right kinds of companies, and therefore they're finding, they've got good pipelines of companies that have recurring revenue. Some of them are even counter-cyclical. We are still even lending on companies where there was a short-term COVID impact that the company has since recovered from. If there is an ongoing COVID impact, we'll know, we would wait and see how things progress. But if it's already in the past and it was short-lived and a quick recovery, then we're able to still lend on those. And, I'm also happy to report that our searchers in our portfolio fared very well during this year and met the challenges very well. And so the more that, the model gets proven out, the more liquidity there continues to be, both on the debt side and I believe on the equity side as well, to continue doing deals. So with that, I am finished with my remarks, and we can open to Q&A.
Thank you for the wonderful presentation. I have a question that is COVID related. Have your processes or your timing or anything changed sort of, in the before time to the now time of trying to get a deal done during this pandemic?
Yes, there is two things that we do additional. One, it is upfront. We have literally a COVID questionnaire that asks a number of detailed questions about the impacts on the company, so we can start to understand those right away. And then finally, there is a closing committee. So after credit approval, there's one last look through the closing committee to make sure that the company isn't experiencing some recent impacts that we want to reconsider or wait on. And that's it. Everything else is the same.
And my next question, then we'll open it up to everyone, is have you had a situation where somebody landed a whale and then you kind of had a feeling that the deal was probably not the right deal for them? How have you handled that?
Well,
that's a good question.
I'll throw in there.
Lisa,
yeah, we have such a, I think, a nice pre-qualification discussion that we have with our clients and our searchers up front, where we are talking about all aspects of the transaction, not just the dollars and the debt service coverage, but the cultural fit. We do a lot of upfront discussion, and I don't think we're getting too far down the path and then realizing it's not a good fit. So, I mean, these are all kinds of vetting questions we're having up front. And We do a lot of discussion around transition plan. How is the CEO going to actually transition this company? So we have a really robust conversations around, well, what is the seller doing? Let's talk about the key managers. Let's talk about the key employees, and how, as you, as the new CEO coming in, how are you really going to transition this company? And I think we find, because of our robust conversation, a lot of that nuance sort of gets vetted up front, because we get into it.
Excellent. I'm going to stop the screen share. And then, Mark, why don't you take a few questions from the chat? And if you want to ask the question live, please raise your hand in the participants window, and I will call your name out, and it'll literally be the first person that I see who has their hand raised.
All right. So I guess just a technical question, which is, will these slides be available as a PDF after the session?
Yes, I don't know if you share them, Karen, but if we can share them on Search Funder, that's fine with us.
Okay, yeah, we'll attach it to the event if you send it to us. Like if there's any markups or anything from what we talked about today, and we'll put the final version in the event itself. All right, so just getting into it, Noel wants to know, does the seller note only count as equity if it's interest only for 2 years?
Well, actually, the seller note doesn't count as equity unless it's on full standby. I think there used to be other SBA rules around seller note counting as equity. That's not how it works right now. And I won't put it in context of this larger transaction, but the SBA requires minimum of 10% down. If you come in with your minimum 10% equity, assuming all the debt service and everything else works, then a seller note can be structured in lots of different kinds of ways to kind of mitigate transition risk, as long as obviously debt service coverage fits in. But we wouldn't really consider seller note to be equity. You need to have your minimum amount required, and then the capital stack needs to work from a debt service coverage and an EBITDA turn perspective.
On that first deal, when was the closing date? Did you have the 6 month financials prior to closing?
Yeah, we absolutely did. In fact, we had a Q of E that proved out the TTM all the way through June, and then we actually got some updated financials on top of that as well.
Awesome. Okay, go ahead.
I can ask the next one so we can alternate. We have a bashful group. I don't have any hands raised, but feel free to, if you have a particular situation that you want to workshop with Heather and Lisa, or an inquiry, please feel free to raise your hand. So the next question is, how do you think about businesses that have a portion of their sales that is fulfilled by Amazon? Do you treat Amazon as a customer? What do you think in terms of customer concentration? And then there's a follow-up to that. If the seller strongly prefers all cash at close, no note, do you see lower purchase prices, and by how much?
Want to take that one, Lisa?
Sure. So with Amazon, and I knew when we decided to go with our e-commerce example, it was going to maybe be compared to like sort of an Amazon deal. This is not that. The Sanita Athletics is a proprietary website, a proprietary deal, as compare and contrast to sort of an Amazon reseller that might have all of their business being done on Amazon without any kind of proprietary website or distinct or discrete sales functions. So the thing with Amazon is, if there's no differentiation, if it's literally toothbrushes or just even vitamins that aren't branded, as an example, that's something that we shy away from. And also, one thing we see with Amazon companies is that a lot of them are recently established. It's not like they're 10, 20-year-old companies. And that's, what we're looking for. We're looking for the seasoned company. Not that these aren't great transactions or great opportunities, but they're really more equity transactions. It's a little hard to put as much debt on this kind of company that is a newly created and has a really high growth trajectory. Those really seem to be more kind of strategic acquisitions or more equity acquisitions. And the purchase price question, give me kind of part B to that, please.
Okay, I will. If the seller strongly prefers all cash at close, no note, do you see lower purchase prices? If so, by how much?
Yeah, and so I'm going to assume that that's not necessarily an Amazon question, but
right, it's separate. Yes,
it depends. We have done transactions without seller notes, and the second slide in here does not have a seller note. So I would say that generally, there probably is a little discount on price if the seller isn't willing to carry a note, but that is a very, very generalized statement. It's really going to depend on debt service. Is there no seller? Obviously, because they are taking some of that enterprise value off of the table. I would say that's probably a good generalization to make, but man, we see so many different kinds of transactions. But generally, we're because in the lower middle market there is transition risk. We do want to see a seller note. A lot of that's going to depend. What's the skill set of our CEO searcher? What's the skill set of any sort of board of director or investor support they may have to mitigate not having a seller note? So, and I'm kind of putting that more in context of an SBA loan. I'm not sure, Heather, how you might add on to that.
Yeah, I mean, I think strictly Amazon e-commerce is a tough deal for us. There's too much control by Amazon to compress margins, and there's a lot of competition, price competition. So I think the only e-commerce deals that we've actually gotten approved have been proprietary website, different channels basically that they sold their products through.
All right. Well, Adele wants to know, why are earnouts not allowed under the SBA loan? Is there a way to structure it by having less debt in the first place? And are dividends allowed under the SBA? What are some of the restricted payments covenants, if any, while you have the SBA loan in place?
So let me go first to the first part of the question. Why aren't earnouts? Why aren't they allowed? I mean, it's a good question. I think the SBA wants there sort of be a fixed purchase price. They don't want it to be a moving target because there's that 10% of purchase price is required equity. So if the purchase price could go higher through the earnout, then how are we going to be sure that we have the 10%? That's kind of the way the SBA thinks about, how are we going to meet the rule if there's a moving target? So we can't have a moving target with an earnout. I think there's also some uncertainties to how the earnout might get paid in some cases, but that could be covered through underwriting. So it's mainly covering the 10% down payment. The only way around it, and it's not necessarily a way around a true earnout, but you can use a forgivable seller note. So you can gross that up into the purchase price, and you can have a seller note B. I'll call it, seller note A is the one that just goes ahead and amortizes, and seller note B would be the forgivable seller note that you would put on standby for maybe up to 2 years and then tie it to a metric. It's okay with the SBA to do that as long as the metric is something, some level of performance that the company's already achieved, as long as it's not a growth metric, because a growth metric would resemble, again, an earnout. So that's one way around it. Are dividends allowed? Yes. I mean, I believe the SBA allows dividends. There are no restrictive covenants in SBA loans other than provide quarterly financial statements and make the payments. And so there is no way to restrict dividends being paid out with an SBA loan.
I skipped over a question by one of our members, and I want to go back to that one. It relates to seller notes, and I'm hoping that you can explain what this question is asking for me. Do seller notes have to be on full standby?
Yeah, they don't. That's an kind of, I think, a throwback to an older requirement on structures before. As long as the client, the borrower, has 10% down payment in as equity, then seller notes can be structured in many different ways. It depends on kind of what you're trying to mitigate or what transition risk you're trying to shore up, or any other structuring reasons around why you would have a seller note. As long as you have your 10% equity, seller notes do not have to be on full standby. However, there is a caveat to that, and an asterisk. The SBA requires at bare minimum 5% from the client. So if 5% equity is coming from the client, then you can reach your 10% minimum requirement by having the seller note on full standby for the life of the loan. That's 10 years, no principal and interest, to kind of meet that 10% equity requirement. I'll say that as a lender, we are not looking to do 90% financing. So if that were the case, 5% equity, 5% full seller note, we would be looking for some additional amount of seller note. We're usually looking for a minimum of 80% senior debt on our SBA lending. And I'll say for Live Oak, generally we're only doing kind of a 5% minimum equity when it is an inside buyer, a key manager buyout, or something like that. We really want some contribution from our buy side.
Thank you.
All right. So for the athletic manufacturing, did the overall increase in online shopping due to COVID play into your thinking on their TTM growth?
Yeah, we asked obviously a lot about TTM growth. We do that on whether it's an SBA or an SBA combo or a conventional. We obviously want to know, is that growth sustainable? What's behind it? Is it sustained? And then from an investment thesis, can you continue to grow the company over and above? So the company added several different product lines, and they've been expanding their product lines that they're offering. So a lot of it was through offering maternity wear, swimwear, etc., out of just sort of basic leggings. So it was an expansion of the basic business model into other product lines. There was definitely some COVID impact because, we're all working from home, and a lot of us professional ladies and athletic ladies are wearing a lot of leggings during the day. So there was some of that, but and I don't think that trend's going to change at all very soon, but it was just the organic growth of the company itself.
So can you talk some about a hybrid conventional SBA senior/junior respectively loan structure? The questioner says, I've recently talked to a bank who said they had done loans like that and had offered additional flexibility on terms beyond what the SBA generally requires.
So that is the example that Lisa gave. That is exactly what that is. That's an SBA with what we call a companion loan. The SBA allows us to share the collateral either as a junior collateral to the SBA loan, the conventional piece, or as what we call pari passu, where it's kind of pro rata collateral. It doesn't really matter a lot to us which of those two structures we use, because these are leveraged buyouts, and the collateral is really insignificant to the deal. But the SBA does allow it. There's not a lot of banks that do it regularly like we do. We do it quite often. And the difference, you've got a 10-year loan with the SBA, $5 million piece, you max that out. And then the additional conventional piece is going to be a 7-year loan with a little bit higher interest rate than what the SBA piece has. But it's still, the entire transaction has to be SBA eligible to use it.
Thank you. And Mark, you are up.
Oh, okay. Do you have some recommendations for quality of earnings providers?
I would say Max is one. What about you, Lisa?
Max Lummis, we've got Hood and Strong, Maori, Plant Moran, Boulay. I think there's a really nice set of service providers on the CPA, QV, due diligence side of things. We could certainly follow up with a list, but there's a lot of nice ones out there. And there are more and more of our QV providers that are recognizing kind of a QV light, if you will, that isn't quite as expensive, but really provides the same amount of due diligence, backup, and still kind of the firepower in that CPA diligence that you're looking for, because they're recognizing that in sort of SBA or SBA junior debt solutions, our searchers are still wanting to get a nice amount of CPA due deal done. They might not be able to afford 50 or 60, but could they afford something less? So I think you're going to see a lot more service providers on the CPA side offering a QofE light that has still got some nice diligence around it.
And just kind of a shameless plug, if you make a post about that on Search Funder, I'm sure almost all of the people that were mentioned, they are members, and we actually see questions about Q&A quite often, and basically the members that Lisa just mentioned are kind of some of the most active in sort of helping you with your QOV questions, just sort of in an online format before you really get into the contractual nitty gritty.
Yeah, I'm happy to do a post and follow up and say, hey, here's the folks that we referenced.
Yeah, that'd be really helpful, I think. And we could tag them and they'll probably chime in.
And so the next question is, what type of operating experience, industry experience do you look for in the acquirer? Given that a large portion of searchers do not have operating experience, they're wondering what you're looking at. For example, my background is in investment banking, so I want to know what challenges, if any, I will be facing to convince lenders that I can actually operate a business.
Yeah, that's a good question. Like Lisa said earlier, we vet you out as a searcher from, our introductory call through pre-flighting deals with you, and we start to develop a sense through that process and over time of what kinds of businesses we think you might be a good operator for. Also, just the way you bring the deal to us, pointing out, what's important characteristics about it. That helps us determine what kind of, is it a good fit? So it's very subjective, but I would say it's not very often that someone comes to us with something where we think it's a bad fit. I think you guys all use good judgment about yourselves as well. But the way we also back up the fact that you might not have operating experience or you might not have industry experience is through your board of directors. It becomes an important part of our underwriting process to understand who's going to be on the board and what sort of experience they have. They usually make up for some of the lack of operating experience or industry experience that the CEO might not have.
I also add on to that's spot on. And I would say that depending on the transaction and the opportunity that our searchers find interesting, I think they do a really nice job of complementing whatever it was the seller maybe did or didn't do well with what they can and can't do well. And then in relation to looking at the operating team and the management team that's going to remain in place in relation to what the CEO's searcher CEO skill set is as well. So I as Heather said, I think the community is very thoughtful about trying to dovetail the kinds of experiences and skill sets that the searcher has in relation to that transaction that they're looking at.
John wants to know how much capital is typically required of a search funder, and I guess that I'm going to hazard to guess that's like how much of the equity has to come from the search funder itself, given that the investors are willing to sign the guarantee as well.
Yeah, not very much is the answer. If you've got investors and they're putting the majority of the equity into the deal, we like to see a small amount, whatever is within the means of the searcher to be put into the deal. But I've seen very small amounts. So I've seen less than 100,000 many times. So it's not a big deal to us that the searcher himself does not or herself does not have a big chunk of the total equity that's being put into the deal.
And two, especially, when you're the self-funded searcher, as this comment obviously refers to, you're spending money during your search. You're spending money on vetting deals, and so you're spending money along the way. Also, we recognize that.
Does Live Oak have a policy when working with non-Americans, whether that's companies or searchers?
SBA does. So let's start there. SBA's policy is that you have to, 51% of the business has got to be owned by someone who is either a US citizen or a permanent resident alien, green card holder. So that's SBA. If it's conventional, we don't have those guidelines, but in fact, we recently approved a loan to a searcher who is here on a visa. And so we just simply vet out what kind of visa, when's the next renewal, and what are the risks around that. And, we got comfortable with that particular deal. So I think it's for the conventional program, it's just case by case. And for SBA, you have to follow that 51% rule.
So we are getting close to the end of our hour together. We have a few more questions in the chat, and Heather and Lisa did promise to stay on after the end of the hour. So we will try to get to as many of those as possible. I wanted to let you know about some upcoming Search Funder events, which tomorrow is our deal sourcing for searchers. We're going to have a meetup of our Black, Indigenous people of color community on November 3rd. And I'm looking forward to gathering the community together, since it's been several months since we've been able to do that. And please look for a notice about a Women in Search event for December. I believe the date for that will be December 10th. Our next operator session will be on customer communication during crisis. And I think there's going to be a lot of great and fun war stories for that event. So please be sure to check out our Search Funder events page for up and coming events. This event has been recorded, and we will provide that on the Search Funder site. The way that you find that is on our past events page. So next to your profile picture, there's a link for a menu, and that is basically everything that Search Funder offers you, and just click on past events on that menu. So let's see if we can get a few more questions in. Mark, why don't you go ahead, and then I will pull up my chat.
Sure. Can you guys talk about I guess this varies from industry to industry, but how many turns on EBITDA do you usually lend for conventional?
Our maximum is 2.75 turns. Most of our deals come in somewhere between 225 and 250.
Okay. It's pretty straightforward. Back to you, Karen.
Can my investor cover the entire equity portion in the capital stack, or is it a must I have to put money up for the funding?
Well, this is part of what we were talking about a couple of questions ago.
Yeah.
We like to see and again, I'm assuming this is a self-funded searcher going SBA. We like to see some amount coming in from the searcher, but I would say for the most part, most of our deals on the SBA side, when we've got investors bringing in the equity, the majority of it is probably coming from outside investors.
Ryan wants to know, can you provide any guidance on the growth plan, on growth plan financing maximums at the time of acquisition, like additional capital, almost like working capital to grow the business? How can EBITDA margin compression go, and for how long? How low can EBITDA margin compression go, and for how long due to reinvestment? Is there growth plan permanent financing, a max turn on that, or a percentage of total debt capitalization? That kind of thing.
That's a lot of question there.
Hey, Ryan, that might be an off-camera discussion, but go for it, Heather.
Yeah, exactly. I'm going to give you kind of a generic answer. That is where we really get into a lot of kind of customized underwriting, if you will, and customized crafting of the covenants, because it really affects the covenants, how much you're going to be investing in your growth. So that's something that's really case by case. But it's a good question because, yeah, you absolutely want to, even though we're not underwriting to your growth plans, we are absolutely needing to structure our conventional loans around your growth plans because of the covenants.
And that's one thing we always ask in sort of this initial getting to know each other on your deal. Is there going to be a J curve, or are you expecting the business you're looking at to not have that dip? There are some businesses we look at on the conventional side where there isn't a J curve, but it's a topic we bring up on every deal.
On the conventional loan, if Live Oak lends up to 50% of the overall value, are there any requirements on equity if you have mezzanine and seller rollover?
Definitely, yes. I don't have a guideline to say it has to be at least 25%, but we're certainly not going to approve something that's highly levered all the way. There's a maximum total debt figure of about 4x. So they can't exceed that. So that if you back into that, you're going to definitely have to have some equity. And usually it's more than 25%. It's 30%, somewhere in there.
If you'd like, does Live Oak have a solution to acquisition of a target located in Canada or the United Kingdom?
No, unfortunately, we don't.
Do you guys, and this is just out of curiosity, do you guys know of any comparable programs to the SBA in Canada? Because we get asked this a lot, and we actually don't know.
No, I don't know either, unfortunately. I do get asked as well, and I wish I did know, but I don't.
And we get asked that question, for all over Spain and, Mexico.
Right.
Really want to thank you, Lisa and Heather. I learned a lot. This is a side of searching that we do not get as deeply involved. So it's wonderful to hear the case studies and to have a better understanding. We will supply the slides. There was a question about the second case study that we did not cover. I would encourage that person to reach out to Lisa and Heather. They are the most open and accessible people I have ever met, and I'm sure they would be willing to walk you through that and any other questions that you might have. Thank you for your time, Lisa and Heather, and thank you everyone who attended and stayed this long. We really appreciate it.
Great. Thank you. Thanks, searchfunder.com.